Well, 2020 will go down as the year that the whole world has grappled with a problem like no other. And the problem is that this problem does not fit into any of the past experiences as well. So what does one do in the current scenario? Well, let's get in two veterans who actually dealt with maybe not similar instances, but multiple equity market crisis situations in the past, and YTD in the current situation are doing remarkably well. Devina Mehra and Shankar Sharma of First Global join me right now on this episode, very special episode of Navigating Through Uncertainty. Both of you, thank you so much for taking the time out and speaking to us. I have a simple question. Whenever one looks at investing, you look at upsides and downsides. Here, there seem to be no clear answers to anybody. How are you guys navigating through this? Either of you can start.
So I'll go first, Neeraj. So basically, this crisis is like, if you look at it in market terms, it's a pure and simple bear market situation for large parts of the world. And we have seen quite a few of these situations happen over the past, 25, 30 years of our investment careers. The one that we recollect vividly even now is the 91 crisis, which was a pure India crisis. It had nothing to do with much of the world and was not affected. Then we had the 97-98 Asian crisis and the dot-com, which was a very localized sector-specific problem, did not really cause any macro dislocations. And then we had the 2008 GFC, which was obviously the mother of all crises. At least we thought that was the mother, and now we have the grandmother of all crises. Because compared to the GFC, this appears to be, at least in terms of damage to the real economy, this is like of a order of like 100x, if not 1,000x, because how many times do you recollect the PMI, the Purchasing Managers Index of any country, let alone India, being 5, right? I mean, when have you last seen that? I don't think the PMI readings ever, since the time they would have started, would have ever recorded a reading of 5, right? That is what tells you the extent of the problem. So it is a problem that is completely uncharted. We thought we had seen it all in 2008. This time has told us that no, till you're alive, you'll keep coming across situations that you've never seen before. This is one of them. Now, but the interesting thing is the world has not taken it. I mean, at least markets have not taken it equally for all countries in the world, and that's the interesting thing. That unlike the GFC and the Asian crisis, in which all of Asia pretty much felt similarly, or the whole world felt similarly in 2008, this time markets have been very, very nuanced in the way markets, globally markets have performed, and we'll discuss that later in the show. But it is not a uniform bear market, at least from a stock market angle, unlike the previous, similar episodes in financial history.
Yeah, well,
I would like to add that, even in the current situation, you have like Nasdaq is up for the year, the S&P 500 is up on a 12-month basis. So as Shankar was saying, it is not a uniform bear market, even though the changes in the global economy are of a scale that none of us had seen. I remember I tweeted 2 months ago that schools are shutting down in a few countries and tourism is down to 0. And that itself was unprecedented, because even during the world wars, that had never happened. And since then, we have just like shut down whole economies with not just tourism, but 0 flights, 0 business. If you look at the Indian fisc itself, the revenues are down 80 to 90% in the center and the state. So the dislocation is of a scale not seen, but still, in spite of that, as Shankar mentioned, the bear market is not uniform across the world.
Yeah, it isn't. And therefore, Devina, let me ask you, I mean, what's your sense of where tops and bottoms are made? I mean, we are in a bear market for sure, but a lot of people say that with the kind of liquidity that is being thrown in across the world, the actual bottom and the actual bottom where it should be and the levels that we might eventually end up might be different, because liquidity might just help the markets tide a bit better. What's your sense of whether it's possible to even figure out what a bottom could look like and how far away from that we could be?
See, again, as I said, that globally, it is not even as if that we are making bottoms everywhere. I mean, as I said, NASDAQ is up year to date. S&P is up on a 12-month basis. So, the markets which have more flexibility, or you can say economies or governments which have more flexibility in terms of pumping in money or other measures, they are that's like one of the reasons why markets are behaving differently. Whereas if you are in a situation where your options as a country are very limited, where your fiscal balances are already poor, where you don't print hard currency, then your situation is very, very different. And we are seeing that the markets are differentiating. For example, if you look at Brazil or India or Indonesia, which run higher deficits, those are the markets which are not doing well. Whereas, whether you look at some of the European countries or Indonesia or the US, where either the deficits are not so bad, or in spite of deficits, the flexibility still exists because of the position of those countries, that the market is already differentiating between the two.
Yeah, it is. So, Shankar, I mean, what's your sense? I mean, if I can slip in a quick India question before we actually talk about the other problems as well. India is not quite in that same bucket, right? Because we don't have the money to throw. And I think the government's behavior, I mean, the government's response in the last 2 or 3 weeks or 4 weeks, wherein everybody's been waiting for the stimulus, the much awaited stimulus, shows that there is less money to throw, or there is very little money to throw, and the government is not in a hurry to throw it as well. How does India then, therefore, navigate through all of this when we don't have the kind of money backing us?
This is a question for me, Neeraj?
Yeah, Shankar.
Okay. So India doesn't have the money. That's very, very amply clear. And what is important is also to keep in mind one very important. Go back to the end of January when the budget was presented. I think it was February 1st or something. Right? February 1st. So what happened then was everybody was expecting a stimulus. So this expectation of a stimulus has not been a new thing post the corona crisis. India has been expecting a stimulus right from the 2019 budget. And when it didn't get anything, the markets tanked from 40,000 to I think 32,000 in the month of August 2019. And then the government pulled out the rabbit out of hat by announcing the corporate tax cuts. And that pulled the markets back up to about 39,000, 40,000. But what it did was basically it just pulled up a handful of high tax paying companies, which your private sector banks were, or the FMCG companies. It did not pull up the small caps and the mid caps. So just a surface level rally was engineered for a while, but the real economy was continuing to hurt, and the real economy was waiting for the budget to come around of 2020. For it to announce a stimulus. But there was no stimulus. Government said, no, we'll stick to our fiscal targets, whatever, I forget what they were, 3.4 or 3.5. But we are not going to go to 4, 4.5, 5. People were even recommending 5%, 5.5%. How does it matter? Just a number. Government was very resolute in saying that, sorry guys, figure it out for yourself, but we are not going to bust our national balance sheet in trying to stimulate the economy. Now, this was even before the problem. After the problem, when you have GST of 30,000 crores, and again in April, and now I think in May also, you may not be any degree better than that. But 2 months, you're already short against 1,25,000 crores. You're going to be collecting 70,000, 80,000 crores less. That's like 150,000 crores, or maybe 160,000 crores less in just 2 months. And then let alone the other elements of the government revenues, which is basically your personal taxes or corporate taxes. Corporates are in no position to pay anything at all. Forget about taxes. They don't have money to pay salaries, right? They don't have money to pay utility bills. So taxes come much, much later in the food chain. So there is no money that the government is getting at the center. And if the government doesn't get the center, there's no money trickles down to the states. This is as doomsday a scenario as can be. And on top of that, you are already, just one level above junk. The government knows that if it puts out a stimulus package by printing a lot of money, you're risking a downgrade. The reality is you may well also be getting downgraded with this kind of a situation in India where companies are reporting zero sales. I think it's just a rock in a hard place, almost like a perfect storm. I think the government will do some cosmetic stimulus. I don't think anybody's going to be fooled by that. And I think we just need to hunker down as consumers, as business people, as analysts for an extended period of very, very low economic activity. It is almost like, going into, a hospital. You're not going to be just running around, in a couple of months' time. This is a very serious damage. It will take time to heal. And that time could be a pretty long time.
So Shankar, I'm just wondering though. So I'm guessing you bent towards the side of caution, which is the government should not give a large stimulus, which a lot of people are asking for because it would have other eventualities like the run on the rupee, etc., etc., etc. You think that is a better thing to do?
I think a stimulus will not help. I mean, if you look at the US, it has already pretty much run through the first round. I think it will be announcing another one very soon. This is America, where already the health infrastructure is still, it may not be great as compared to maybe a South Korea or something, but still pretty good by any standards. They're already running short of the first round of stimulus. They'll need to do another round. India knows that even the first one that it will do will be grossly inadequate. That means throwing good money after bad. And I think, and I do believe that if you do this minor stimulus, you will achieve nothing. But in bargain, you would have further damaged your national balance sheet. So it is just that, let's say you're facing a dehydration situation, right? If you give the dehydrated patient one bottle of water, it's not going to be of any use. You need to give a whole, maybe tanker of water, but you don't have that tanker of water. You can give him only one bottle of water. And you have only one bottle of water. What do you want to do? You want to keep it for yourself, let the patient, struggle? Because if you give it to him, he's not going to survive, but you're not going to survive either. It is that kind of a situation, unfortunately so.
Devina, let me add to that in terms of the, not just the stimulus. Right now, the government doesn't have the money to pay its dues. Recently, I saw a union minister saying that I cannot even give you the figure of how much we owe as the government to MSMEs. It probably, could run into lakhs of crores or at least above a lakh of crores. So, if at all the government had to do something, the first step would be to pay its dues. But given that it's not even in the position to do that, talk of a stimulus is like all too far.
Are you guys bearish? Well, maybe that would be an obvious answer, but I'm just wondering, the market, we've seen a bit of a disconnect between what the economic realities are versus what the markets are now for a number of times, and it's probably happened a number of times in the past as well. Do you think this time could be different, Devina, or do you reckon that we are right now in the hopes of maybe a stimulus or a global liquidity, etc., moving higher, but eventually, looking at the hard realities, there is no reason for the markets to be trading where it is right now?
See, if you go back a month or a little more than that, we had said that given the way the markets had fallen in March, a rally was due, because that is the nature of markets, that when you have that kind of vertical fall, the market just doesn't keep on falling, regardless of what's happening in the underlying economy. So, we expected a bounce back, which came, and we had positioned our clients' portfolios accordingly, which means that, after reducing equity in February and March, we went back all in by 1st of April. But we are quite clear that this is not supported, by economic fundamentals, but as you were saying, that for some time there can be a disconnect. But this time the dislocation is very, very high. And we don't think that we have seen the end of this bear market by a very, very long shot. That doesn't mean, as I repeat, that the market just keeps going down. That's not the way it happens. So at each point, you have to take a view on what's going to happen next. But the economic situation and also, therefore, the corporate earnings situation will remain very, very dire.
So from our perspective...
Yeah, sure. Continue, Shankar.
So it is not about the being bearish, bullish, or whatever it is. The fact of the matter is every market has its own unique characteristics. We have played India in the month of April by not having a single bank or NBFCs, which we have not had even in February and March, and we had no reason to go back into them in April, but we went back into equities. So it's not that we did not buy equity. We were 100% invested on April 1st. We rode the rally up. We are, I think, in even the results that have come out, we are amongst the top 2 or 3 performing PMSs, even in the month of April. And when you combine March and April, I mean, it's like a wide gap because we are actually up for the year now. The point is you avoid, when you're realistic, you avoid dangers in the market. So if you are living in a dreamland, then you say, worst is over, let's go and buy the riskiest end, which is banks and financials, right? And you're going to get clobbered in that. Forget this rally. Those have not seen a bottom. But on the other hand, in our portfolios, we had about 5 stocks which are up 80% in the month of April. 80% in the month of April. So we have found the right spaces, we have played the spaces, and we have delivered the number. So it's not very bullish. It's simply you're realistically seeing the market landscape and you're saying, all right, I don't want to be here, but there's still good places where I want to be, and we have played that end of the market. That is a very neutral view rather than storifying a thematic that India has been the bottom or liquidity will come and market. We don't get so intellectual in the marketplace. That's not our style. So the fact is, economic landscape is bad. That we all agree, but there are places to be making money. We are positioned there, and we have made that money even in the month of April itself.
So Shankar, what does the landscape look like right now? I mean, I understand that. Let's not get into believing that, okay, what could be the bottom, what could be the top? What is the landscape telling you right now about how to position yourself in India? Then I would also want both of you to dwell on India versus the world and equities versus other asset classes. But how do you position yourself in India? Both of you, starting with Shankar.
No, so we have been positioned, in obviously pharma. We were right there, the beginning of the sort of up move for the first week of April. We have written that. We've had chemicals. We have had some other sundry companies, which have done extremely well in the last 1 month. Areas we have avoided are what I just told you, that we have completely avoided the leverage space. Because that's not where we believe you should be. If you are a prudent investor, if you're an aggressive investor, you can play that, and you might even get a 20% rally. I don't disagree with that view at all. That's not our style. That's not our strategy. We've avoided that. The fact is, pharma globally has done quite well. So again, it is not a theme that has been unique only to India. Even in our global portfolios, our pharma stocks have been up like 20, 30, 40% in the last month and a half time. So certain themes have been pretty global because the world has obviously, people have come to the conclusion, people become more health conscious, or there's going to be more investment on drug and overall medical infrastructure, etc., etc. That's whether that happens or not is another matter, but at least the market believes it will happen, and that's good enough to do a trade right now, which is exactly what we have done. And we don't see any reason to change things dramatically just yet.
Devina, you want to add something to that?
Yeah, I mean, what I'd like to add is that even when we think that a certain space or a certain sector looks good, we are always very careful of the portfolio construction of the risk. So that means no outsized position on any one company and no outsized position on any one sector. So that those parameters of risk management also have to be kept in mind. Globally, of course, I mean, other than pharma, anything which helps you work remotely or consume things remotely or exercise remotely, all those are the other themes, digital and anything which allows you to do things remotely. Those are the other themes which are playing out globally. But whatever you do, please keep risk management in mind, the construction of your portfolio in mind, and asset allocation in mind. So that would be what I would tell investors.
Okay, a follow-up, Devina. A month ago, I was looking at the oak tree. I mean, Howard Marks moderated a conversation between himself and 3 of his emerging market colleagues. And they believed that the headline in India was not COVID-19, but the shadow banking crisis. One, do you think even if we were to go past this hurdle, if we do, how we do, nobody knows, is that NBFC banking crisis still looming large? Will that continue to have an impact on economy and on earnings? There are a handful of brokerages which have come out and said that FY21 is a washout. We might actually not see any earnings. If at all, we might even see a degrowth in FY21. What are your thoughts here?
Neeraj, quick one. The meeting, Neeraj, quick one. The meeting might end. We'll need to log back in. You may have seen the notification just now.
Okay, sure. So maybe this answer, and then we'll try and log back in as well. But
Yes,
let's try. Series. Thanks, Shankar. Thanks for that. Devina.
Yeah, we've been negative on the banking and NBFC space for a long time, and in fact, we have not owned a bank or an NBFC even prior to this COVID crisis. So we've been quite clear that, as Shankar also mentioned, that even prior to this COVID crisis, I mean, now that seems to be the overarching thing, and that seems to be the explanation for everything. But the fact is, the Indian economy was not doing that well even prior to this particular crisis hitting. And the NBFC problem has been, again, like a snowball going further and further. And we know the issues. We know that you are borrowing short-term to lend long-term. You are borrowing to borrowers who probably the banks themselves didn't want to lend to, and it's not as if the bank's asset quality has been good, again, not just like for 2 months, but for several years. So that was anyway a big issue, and now we do see a big banking and NBFC crisis that I don't think we'll be able to avoid that. I don't see what will happen which will help us to navigate that, because since then, this was like, if you go back 4 months, there were certain amount of sectors or borrowers that didn't look good. But now you are in a situation where even the good borrowers, due to no fault of their own, are seeing earnings. Like if you're a multiplex, your earnings are down to zero. If you're anything in the hospitality range, your earnings are down to, again, negative, because that's a very high fixed cost industry. So even if the lenders had lent prudently, which not all of them have, you would still have a problem. So, that is not an issue that's going away as far as the crisis itself is concerned.
Okay, so since the meeting might just get hitched, we'll try and repatch Shankar and Devina. But, I just want to, viewers, in the meantime, while we're just waiting for that to happen, tell you about what else is that we will do, because I know a lot of you have asked some questions as well. I'll try and take some of the questions. I urge all of you not to send in too many stock specific questions, because I doubt our guests are in a position to be able to talk about specific stocks. Maybe I'll try and ask them about a question or two, but yeah, frankly, I mean, a recommendation on an HFCL or a Vodafone Idea, that might be a bit difficult to ask really. What I can do, and we will talk about some of these blue chip NBFCs, maybe some of the telecom plays, etc., if they're at liberty to talk about that. What I will want to talk about with them, and I think Cyrus on Facebook asked this very interesting question about what happens to earnings, which is what I tried to ask. We will try and talk about gold and Bitcoin as well. Are we looking at a hyperinflationary scenario over the course of the next 4 or 5 years? Once the world tackles COVID, and I cross fingers that the world does that, and therefore, with all this money sloshing around, are we looking at a hyperinflationary scenario? And can gold, can Bitcoin, all of that come to the fore? I don't know what views they have on both of these, or if they have views, but I'll try and talk about that as well. There's a lot of talk about leadership change in a new bull market. So we'll try and talk to both of them about whether there will indeed could be a leadership change. Would the blue chip financials, the likes of HDFC Bank, HDFC, etc., which have not been the leaders only of the last cycle, but of the last few cycles, could they take a back seat, and could pharma, maybe could consumer durables, etc., be the next leaders of the next bull run? It's difficult to actually see that at the point of time. I'll just, while we wait for them, just a quick anecdote, viewers, keep this in mind. In 2008, 2009, if somebody was told that a real estate company or a Larsen & Toubro or some of the others will not be the leaders of the next decade, it would have been very, very difficult to believe, simply because 2003 to 2008, all that we had done was log up on a stock because there was land bank. A construction company trying to indeed construct X kilometers of roads, and you quickly give them the multipliers. That changed materially in the last decade. So not too many people anticipated that. Not too many people believed that the pharma bull run that happened between 2009 and 2013, 14, while the other markets were soft, was also there. So, leaders change, and that's the question that we'll try to ask them. I'm told both of them are back with us. Thank you so much for doing this. Technology has its own limitations as well. But Shankar, I want to start off with you now about this whole thing about crude. A lot of people, and a lot of, rightfully so, that crude coming off is in a normal scenario beneficial for India. But I think a tweet from you that came out, I think 2 days back, which says that what gives maximum pleasure one day gives maximum pain. What were you trying to indicate? Because it was pertaining to crude.
Yeah, well, so I keep reading a lot of nonsense. So, don't take everything too seriously, including the tweet that I did, a couple of days back. So, um, you know, the fact of the matter is we thought, in fact, by the way, we bought crude, a few days back in our global funds. We thought it was overdone. We thought it was due for a reasonable move up, because let's also accept that the world cannot continue like this. The world will, one way or the other, try to achieve some degree of normalcy. So from where consumption of oil has been, it can only go up. Okay, you're already hit rock bottom. So when it goes up in markets, you don't need to go from 0 to 100 in terms of perfection for something to rally. All you need is from 0 to a 20 move or a 0 to a 30 move. So that's a basis on which in the mid-teens we thought crude was a no-brainer buy. I mean, it's up very sharply in the last week's time. So we are looking pretty okay on that. For India, crude at 25 never helps actually, because it doesn't get there without a severe recession being there. So the last time it was around this price, which was in the late 90s, it was about $10-15. That was in the aftermath of the Asian crisis, which was again a very, very severe problem for all of Asia as well as for India. So something like a $40-50 crude kind of shows some degree of equilibrium in the world. The world is not rocking hot, but it's not as cold as it right now. When people started to salivate over $20 crude, I was telling them, look, this is not good. This is telling you a very, very problematic picture. I would rather have crude at 40 or 50 than at 20. So therefore, and the other thing is, there is no consumption. So what is the beauty that you're so-called talking about saving? The beauty is, you save. The price you save is, when you ultimately consume. When you're not consuming, there's all really, mythical savings. So, for India, 40-50 crude is better than at $20. And I don't think government is getting any real benefits out of the situation, except obviously the price hikes, which are kind of a desperate situation for a desperate exchequer.
Yeah, well, that probably sums up the story, to be honest. So then let's try and talk about what could one do possibly within India first, and then we talk about India and the world and the opportunities thereof, if at all, and something that I want your views on, which is gold and Bitcoin. But just first, let's finish this India portion. Shankar, to you first. Most spoken about phrase that leaders in a new bull market always change. What are your thoughts on this?
So even now, if you see in India, the leadership is changing. So, for example, pharma was in the doghouse for several years prior to the breakout of COVID, and obviously for very well-deserved reasons that the US Fed, and there were a lot of not the Fed, the FDA, and there were a lot of governance issues in some of the major companies that we are all aware of. So all things put together had put a big cloud on the sector. And then this COVID thing has come, and suddenly the whole world has discovered, at least Indians have discovered Indian pharma, the world has discovered global pharma. And most stocks in the sector globally and in India have done very well. So that's one change in leadership. Second, of course, is, the telecom space in India, has really come back after like 10, 12 years of hibernation. Again, in part because of the fact that there is a global boom in companies supplying goods and services to the digital economy. And in India, there is only two players available, to play this end of the market. Unfortunately, it's a very narrow set of companies, or maybe 2.5. So
2.5. Okay. Well, that was interesting. I don't know if I think we'll just try and get Shankar back. I don't know if Devina is also there. Devina is there. If she is, okay. Let me just try and get. But yeah, 2.5. So I think when he's talking about leadership, he's trying to talk about the telecom space, one where I presume they believe that there could be leadership, and pharma. What I want to ask him also, and ask Devina as well, is about whether the leadership change would happen in the financial space, because some of the financials rode multiple cycles, right? A lot of you asking questions about Bajaj Finance, for example. It was very interesting to get their thoughts there about whether consumer financing companies are dead or have taken a back seat, and can they come back? Because at times companies go through a bad cycle and then come back stronger, and therefore would a Bajaj Finance, would HDFC Bank, the consumer financing side of the business, would all of that bounce back or no? So that is I think, a really important thing to understand from them. How do they understand this? So that is part one. The other thing is, viewers, I think a lot of people are talking about what some of the global plays and the export-oriented themes. I think I have a lot of questions, even on my Twitter timeline, about this, about what of some of the globally exposed themes, the likes of IT, the likes of metals could do, and I think it'll be important to get a gauge from them on that piece as well. So these are a couple of things that I'll definitely try and ask both Devina and Shankar about. Lastly, keep in mind, I mean, amongst other things, I would love to know how they are allocating money in their portfolios or for the client portfolios between India and the world and the other asset classes. So could India be heightened 50, 60, 75%, and the remaining money be in gold, some US assets, etc.? Because there are a couple of funds which are doing that. Parag Parikh Mutual Fund, for example, has about 33% of their assets invested in global stocks and only 66% in the Indian stocks. So are they looking to do a strategy which is of that mix? I think that'll be the other interesting thing to figure out from them as well. Okay, so those are a couple of things that we will indeed look to watch out for and hear out from them. I'll try and read out a few questions and try and see what is it that we can possibly ask them as well. So yeah, some of them is some of the viewers, Ashish Prasad, for example, is asking for an update on the oil and gas sector. Ashish would be interested to try and figure out from Shankar what he means, what he believes could happen, because he has some very strong views on crude. So therefore, that is one thing. I doubt I can ask about, Gaurav, I doubt I can ask about Vodafone Idea really, but maybe telecom at large could be. Sorry, my producer is trying to tell me something. Do we have them? Okay, we're trying to connect them. That's okay. We'll try and get them in just moments from now. Just hang on, viewers. At times these things keep on happening. We'll try and get them back any moment. The other thing is, yeah, I mean, Josh Matthews is asking about whether people will continue doing mutual funds and SIPs. Well, Josh, maybe people would, depending on what the advisors are telling them and how much they believe in the India story. So if indeed the economy is to bounce back, then maybe the SIPs would actually help. But if indeed we are in for a prolonged downturn, then maybe if people don't see any kind of returns coming into their SIPs, then at some point of time, people might believe that let me not do this. Maybe the fixed deposits are giving better return. It might be counterintuitive and counterproductive really to think like that. But you never know. It could very well happen. So that's the other bit. Now on Facebook as well, I think a bunch of questions that have come in. I think Cyrus was asking about the point on EPS and what could happen to earnings. Well, I've tried and asked Devina about that, and I must tell you that a bunch of brokerage houses, the likes of Motilal Oswal, etc., I've already said that earnings for FY21 would be zero or flattish compared to FY20. So keep that in mind. Kashif Ahmed is asking about whether they are invested in private life and general insurance because they're invested in digital plays. Well, Kashif, that's an interesting question. I'll try and ask them. Non-lending financials. So would AMCs, would insurance players, all of these be interesting ones to focus on? Yeah, important ones. So a lot of money managers, a lot of very smart individual investors have said that life insurance and general insurance seems to be a place which might continue doing well. Non-lending financials essentially, and you might well have a whiff of broking companies and AMC companies also fitting that bill, but just insurance. So that's the other bit. You know what? I think what we should try and do is, even if we can't get them on cam, we should try and get them on the phone, because it'd be important for our viewers to hear Shankar out, hear Devina out. It doesn't matter whether it's on cam or on phone. So you have to, let's just try and do that. If I can request my producers to try and get Shankar Sharma on phone at least, because it'll be nice to get this going on the phone as well. 3 or 4 questions left before we wrap it up. So it'll be important to get them even in that format. So just hang on, viewers, a couple of minutes, and I'll try and do that. Remember, just one more question on 2 more questions on India about the portfolio reconstruction, and then we talk about the global piece as well. So that's the other thing, yeah, that you have to bear in mind, that is what we'll try and do. Yeah, so I've answered a couple of questions at least to the best of my knowledge based on what other fund managers have told me. Just waiting for Shankar's phone to get patched and try and then see if we can get some answers from them. And we'll try and of course get Devina as well. Okay, so we don't quite have Shankar on the phone line as well. Just try and get this going in a moment from now. Okay, let me just try and base on the back of the questions that I have and the back of the answers that I've received from some of the mutual fund investors to try and give some answers to our viewers. And then by then we'll hopefully try and get either Shankar or Devina in. Well, George Zillion is asking about where is the Nifty headed to. Well, George, I think anybody's guess. I think both Shankar and Devina said that they wouldn't have an idea about what the index could do in the near term. But yeah, the medium term could be a completely different story. Okay, what else? Some other questions. Shankar's view on Bitcoin cryptocurrencies. Yeah, Josh Matthews, I'll try and answer that as well. So, okay, after a bit of hiatus, we have them back. Well, maybe, absence make the heart grow fonder, and we have both of them back. Sorry, Shankar, I think I lost your answer. So before I ask the question to Devina, you were just talking about, you spoke about healthcare, and then you were trying to talk about telecom and how it's a 2.5 legged horse of sorts that we have in India.
Yeah, so if you see in India over the last couple of months, at least a month, the big movers have been telecom plays. And as I was mentioning before we were cut off, I think there are just two companies or 2.25 companies. So there's not much of a choice, but that also ties in with the larger global move towards companies supplying the digital economy, which is going to be largely now probably homebound, not traveling so much, so need for bandwidth, data, connectivity, software, tools, apps, all those kinds of plays. In India, we don't have that kind of luxury of choices, but we do have, those two companies, and both of them have done really well in the last month and a half time. So with the limited choices available to Indian investors, that appears to be, at least for some time, a decent place to, at least it's a safer place, let's put it this way, as compared to the old favorites of the banks and the financials.
Okay, Devina, let me ask you, because I've heard Shankar enough now in the last 1 month to know that he believes that financials are not the place to be in. If anything, I think in one of the webinars he mentioned that you halve them, then you again short them, then you again halve them, then you again short them. So my question to you is, what about consumer-facing financials which are high quality? Because is that space dead, or will it take a back seat? And then part two of my question again on financials, Devina, is that what about those companies which have actually not been leaders only of the last bull run, but have lasted for a number of years now? I mean, the HDFC twins, for example, have been around not just in the last 10 years, but for a really long time. What are your views there?
See, I wouldn't like to talk of specific stocks, but the fact is that even so-called better placed financials will see pressure. As I said, that there is one category of financials where the lending practices were poor, and the second category is where the lending practices may not have been poor, but the resultant is still the same because of the big disruption. So it's not just companies, but even if you look at individuals, people are losing their jobs. People who were, if you look at, for example, microfinance, there are like a whole lot of companies which lend based on that, okay, say this, this plumber or this whoever has this income every day, every week, so on. And suddenly all those people have no income and therefore no means to repay. So the disruption that is one part of the thing, that the disruption will hit everybody. Of course, it would be if you look at the MSME portfolio, which again, a lot of so-called good quality banks have, they could be very badly hit on that across the board. The second part is also the valuations at which some of those good financials were trading at. So when you're trading at, 6, 7, 8 times book, that is where you have an issue, where, the book itself becomes suspect when the NPAs start to rise in that fashion. They said a lot of it totally unpredicted and unpredictable, because who would have thought that things would, there would be no flights, there would be nobody going to hotels or restaurants or multiplexes or XYZ. So the disruption can be very, very high. And as I said, that to start with, we did not like the space. In fact, on January 1, we tweeted that this is an extremely crowded trade, and these kind of trades always end badly. Because if you look at last year, if you look at the entire Nifty move, it was with 10 stocks, and I think 6 of them were financial. So that was extremely crowded trade. And regardless of the quality of the management for some of these companies, we might admire the management, but regardless of that, the stock is a whole different thing altogether.
Just a quick follow-up, even non-lending financials, Devina, you would have the same view?
See, the leverage ones, you have more of an issue, but that it's not a space that we like as a whole.
Okay. Okay, fair call. One more question on India, and there are a bunch of people who are asking these questions. By the way, I don't want either of you to answer stock-specific questions. Excuse me if my question sounded like that earlier. But Devina, one of your tweets mentioned that you hoped that middleman elimination is needed in India. Now, do you reckon that with what the telecom players are doing and building this whole Kirana format, which is large scale in nature, and the near-term economic pressures might force customers to downtrade as well, are staples, which have largely been the staple diet of investors, also in for a rough time? Down trading, lower margins, tougher customers to talk to over the next decade. Are these valuations going to sustain for the levers, the Asian Paints, the works?
See, there are two categories in that. There are certain things which are discretionary, which can be postponed to the next year. So those kind of things, I think you will see direct pressure from customers given the limited choice and the limited money they would have. The second is, pure everyday staples. There would be some amount of down trading. There is currently, of course, as we saw from levers volume numbers, that currently there is also pressure simply because, there is the availability is an issue. Even for me, if I want to order, XYZ brand of toothpaste or soap or whatever, that may not be available. So that's a short-term issue. Longer term, more than large scale down trading, the valuations remain a concern. That in India, the thing is that anything which is halfway decent, which doesn't require capital, where there is some predictability of earnings, the valuations just go through the roof. So that is something you have to play very, very carefully on that front.
Okay. Now, Shankar, how do you assess India versus the other options? Indian equities versus all other options, global equities, gold, what have you?
Well, I think it's a no contest, and I think again, we tweeted this a couple of days back, 3 or 4 days back, that just in this year alone, 2020, gold is up 24%. Government securities or a fund, if you bought a gilt fund, up around 5 or 6%, and Indian equities are down 24%. I mean, that's the kind of divide you've seen. And even last year, gold was up another, I think, 20-25%. Indian equities are up maybe some 8 or 9%. So I think that's really bringing us back to our central mantra amongst the other 3-4 mantras, which is that you need to have very correct asset allocation right from the top down. Second, manage your risk very, very carefully, because if you don't do that, then all the good work done in a bull market will be unwound in a matter of 2 months in a bear market. As we have seen, many people have lost. Headline indexes might have lost 25-30, but actually people have lost 30-40-50%. We get emails from clients or leads every day. It's a really distressing situation. Mutual funds, 1 year returns negative, 2 years returns negative, 3 years returns negative. I mean, it's just a wasteland of returns. As compared to that, if you look at globally, whether you look at this year or you look at last year, countries like Spain, Portugal, Switzerland, I mean, all these countries are hardly high growth countries, but delivered 25% dollar returns, 28% dollar returns. Russia delivered 50% dollar returns. Brazil was 40% dollar return. India was 8%. This year, India is amongst the worst performing right at the bottom, along with Brazil, Mexico, Indonesia, South Africa, India. While at the top, you have markets like, obviously, the US is in a different zone, but I mean, not just that. I mean, look at Taiwan, South Korea,
China,
SMI, China, Switzerland, all these markets. I mean, they are not in a bear market. They are more like a corrective, small correction in what is an uptrend. So Indian investors have been just too much like a frog in the well syndrome. 10 years, there has been zero returns from India in dollar terms. 1 year, zero returns from India in dollar terms. This year, negative returns from India. Indians have to think more global if you have to sustain and build wealth for your future. Because looking at the industrial scenario in India, there will be pockets, as I said, we can play those pockets, but a widespread bull market. I'm talking a real India bull market, not a 10-stock bull market. That is of no help to except for people like us who can play it and make money and live in a comfortable South Bombay homes. That's not what the country wants or needs. It needs a widespread bull market. That, unfortunately, is just not there in India right now for a while to come. So what do you do with your money? As I've just mentioned, fixed income has done better. Gold has done better. Global equities have done better. Global fixed income has done better. There is a world out there which Indians need to explore. We can't be just saying, India hi kiya, India born, so therefore the rest of my life is supposed to be just India, India. We have to now start thinking global. About time.
You reckon you both? I mean, both of you feel free to come in whenever you want to answer. But do you reckon, guys, that the time is still ripe? I mean, because we've seen a bit of a rally into, for example, gold, etc. You reckon that they still might give better returns than Indian equities?
So again, I'm not. So okay, yeah, David. So I'm not making a case of either or. All I'm saying is in an investing pie chart, you need to have all the components. Unfortunately, there is far too much emphasis paid on only just one aspect of investing, that too, and that is Indian equities. But like I said, you have gold, which is a tradable asset class, very liquid. Press a button, you can buy and sell. Same with GSEC, same with global equities. You have to construct, you take a portfolio approach, an asset allocation approach, rather than just looking at one part of the pizza, which is just the Indian equity piece of it. So it's not, I'm not saying that forget about Indian equities and just go and buy gold, or forget about Indian equities and just go and buy, some global equities. It's not either or. That's where most of us go wrong. Like, for example, even in global, people are now coming and saying, buy NASDAQ, buy NASDAQ, buy NASDAQ, right? Or go and buy only US. What happens to the US falls? Yeah, again, back to the same problem, that you will end up losing money because everybody forced you through the sheer force of marketing to just go and buy the most popular index at that point in time, which right now might be NASDAQ. But who can say? Like last year, NASDAQ was not the best performing. It was Brazil and Russia. This time, NASDAQ is the best performing. Next year, again, something might change. So it's a little bit of a complicated thing. What I'm saying is you need to have your pizza arranged properly to take advantage of any bull market in any asset class, because at the same time, some asset class might be in a bear market and some asset class might be in a bull market.
Devina, you want to add something?
Yes, I mean, the thing is that Shankar mentioned that right now, because NASDAQ has done well, people think just, if I want to diversify globally, it means buying a ETF or a feeder fund into NASDAQ. But in all these things, the leadership keeps changing. What you mentioned for stocks or for sectors, the same thing holds for countries or for asset classes. And normally in any kind of fund marketing, if you're trying to sell a single asset class, you tend to lag. So you are selling whatever is now known to be very, very good at this moment. So if you go back, emerging markets did very well from 2004, 2007. So at that time, a lot of emerging market funds were marketed. Now NASDAQ is doing well, the NASDAQ funds would be marketed. So you are always behind, because by the time you enter, which we've seen in India also, that when the pharma sector was doing very well, you had these pharma sector funds, similarly for IT and so on. So you are always behind. So what you need to do is something which is a more dynamic asset allocation. Russia and Brazil were among the top performing. Russia was the top performing market last year. This year, they are like absolutely at the bottom. Brazil is, I think, about the bottom, and Russia is among the bottom 5. India, of course, has the distinction of being towards the bottom in both 2019 and 2020 as well. But otherwise, the leaderships change. Even in terms of commodities, gold has done very well the last few years, but throughout the 1980s and 90s, it didn't do well at all. It did nothing. Just as in the mid around 2004 to 2008, you had this big commodity rally, but before that, steel did nothing for 30 years. So anything that you are playing, you have to do it. That what is my pie chart? What is the asset allocation? And all asset allocation study, all investing studies. If you any investing 101 book, first page, it says that 85 to 90% of your returns come from asset allocation. We like to think about and talk about in cocktail parties about which is the hot stock and which is the multi-bagger I got, but your returns are really mainly determined by which asset class, which broad markets you are in what proportion at a point in time.
Okay. I won't take too much of your time because we've been with you for about 53 minutes already. Never mind those interferences in between or disturbances in between. But to both of you, a question. There is a lot of mention on the Bloomberg website as well, for example, and a lot of people speak about how with the currencies printed at some point of time, we might be looking at a hyperinflationary scenario, and therefore gold is a no-brainer. Is it as simple and open and shut case, or is there more to it? Is that one of the reasons why you, for example, believe in gold?
No, are you saying hyperinflation in, I mean, where?
I mean, the conversation is that done at some point of time, the US will will face some bit of inflationary scenarios, and that would be productive for gold. Is that a legit argument?
Yeah, but if it has to face it sometime in the future, why on earth am I going to buy that hedge against that inflation today?
Okay.
That's absolutely nonsense. Right? Who the hell can say that US is going to face inflation in 3 months, 6 months, 12 months, 2 years, 5 years, 10 years, and I should do that trade for a future possibility today and sit and nurse a position for the next, God knows, indeterminate amount of time? That's absolutely absurd. You can, there are other arguments to buy gold, but to buy it for the sake of, to make up an argument to say that there's inflation coming back, let it come back. Let the data tell us. Inflation is the most commonly available data in this whole world. What is the mystery in that? Let it come, we'll see. The larger point is gold has done well. Now, in the last couple of years, from around 11, 1200 to now 1700. So we are now finding reasons to support a move. And we can find enough reasons in this world to support any move up or down. So now if it is corrected a bit in the last couple of weeks as it has, you'll always say, people are now saying there's no inflation danger in this world. Hence the gold is correct. And oil has run up, so now we'll say, world is now saying, okay. So bahut zyada ho gaya tha, now we'll start consuming oil, so oil is now running. Hey, these many things in the markets are random, right? So my view is, as an Indian investor, gold is a liquid traded commodity. I mean, forget the jewelry part, you can buy a gold ETF. And it is a great hedge against the currency depreciation, which is a real and a presently visible issue. Unlike global inflation, which nobody really can forecast, and at least we don't belong to the camp which says that it's going to be visible in the next couple of quarters. So gold is a great investment for Indian investors, without any doubt, and it must necessarily occupy some part of your portfolio. Depending tactically how you view it, you can increase or decrease it. For example, in one of our PMS schemes, we have about 20% gold. By the way, that scheme this year is up 10%. In a market down around 25. That's because primarily we cut our equity exposure. It's only 30%. We've had 20% gold, and we have about whatever 40-50% of GSECs. So those two are up. This one is down, but here also because we maneuvered a little bit well, we are up. So that only goes to tell you that it is at the apex if you get things right. That okay, where am I positioned? By and large, you will be okay. You may not blow out the lights, but you won't get busted. You won't go bankrupted, as many investors have in this particular fall. I'm sure you guys hear of a lot of it. We get emails practically on a daily basis, which makes your eyes mist over. It is a tragedy. The kind of things we read, that my retirement went or my kids' education went and all this. I mean, it is heartrending. You need to avoid those situations. Unfortunately, all the messaging is that equities are a perfect all-weather instrument. Keep buying, 40,000 buy, 35,000 index buy, 30,000 buy, 25,000 screaming buy. Did you come and tell me to sell at 40,000? No, you did not. That's the kind of irresponsible marketing done by mutual funds and their distributors, which leads people to write these kind of emails. And trust me, I'm not making this up for the sake of the show. When I read those emails, I really feel for those people. Their whole life savings have been evaporated. All because you were sold a story that it's only equities and nothing else that should be there in your asset allocation pie chart. It is absolute nonsense.
Wow. And there's emotion coming through as well. Let me ask you a final question, and Devina, maybe I'll ask you first and then maybe Shankar. Any thoughts on Bitcoin? It's a very narrow market. Very few people want to know about it, but it's turning up because it's moving higher. Have you guys studied that?
Sorry, your audio went a little in the middle. What did you say?
I was asking if you studied Bitcoin at all. Any thoughts on that one?
No, Bitcoins is not something that we have studied in detail, so I would not like to give my view on that. But I would just like to add a bit to what Shankar said last time,
Sure.
that in the last answer, that one is, of course, asset allocation, and related to that is risk management. So please, whether you're managing your investments yourself or whether you have a fund manager or an advisor, the main thing in markets is to protect against the big loss, to make sure that there is no big hit to your capital. Because once that happens, it becomes very, very difficult to come back. So if you are down, let's say 35%, it will take you a 50% up move to even come to break even. So even if you have 3 up years of, like, let's say you have 20%, 10%, 12%, like that, the market goes, it will, after 3 years, you will be back to just zero to your. So be very careful that at no point does your portfolio take a hit from where it is practically impossible to come back.
Okay. Well, Devina, Shankar, it's been a pleasure. I could go on and on, but I'm sure we have time limits as well. But thank you so much for your time today. And look forward to maybe talk to you when the times are slightly better, on the other side of COVID, as we like to say.
Yeah.
Sure. Thank you. Thank you for having us, Neeraj.
The pleasure is ours. Pleasure is ours, all of us at BloombergQuint. And viewers, thank you so much. Well, some of the questions we tried to ask Shankar and Devina, they obviously couldn't talk about specific stocks, but I hope you got in part your answers to gold, to asset allocation, most importantly, and to equities as well. From the sound of it, they didn't sound too bullish, but you never know, things could change. But thanks so much for tuning into this very special episode of Navigating Through Uncertainty.